navigating the stock market's resilience and monthly dividend portfolio strategies. Hello, everyone. Welcome back to another episode where we delve deep into market trends, financial strategies, and investment insights. Today, we're talking about two major topics: the resilience of the stock market in the face of economic challenges and the creation of a high-yield monthly dividend portfolio, perfect for those looking to generate steady income. Let's kick things off with the big question: can the stock market keep going up? Hey everyone, welcome to Market Visionary. I'm just starting out and I need your support. If you're enjoying this content, please hit thumbs up and subscribe. As a thank you, I'm offering gifts to my early supporters. Just comment, subscribe, take a screenshot, and email it to the address in the description. You might get a special reward. Thanks for being here. Let's grow Market Visionary together. Many market watchers believe the answer is yes, largely due to a combination of factors that are keeping investors optimistic. There's growing confidence that the Federal Reserve will manage inflation effectively, ensuring the economy remains stable while corporate earnings continue to rise. Let's break down why this is happening and what we can expect moving forward. Stock market resilience. What's driving the optimism? In recent months, we've seen stocks climb significantly, and this surge comes on the back of interest rate cuts by the Federal Reserve. When interest rates drop, borrowing costs for companies decrease, boosting profits and raising the market's valuation. This is particularly appealing to investors who, as a result, see stocks as a better bet than bonds. A prime example of this can be seen in the performance of the S&P 500. Since the last interest rate cut, the index has risen by about 4%, and it shows no signs of slowing down. Investors have poured billions into funds that track U.S. stocks, reflecting growing confidence. With corporate earnings season underway, many of the country's largest companies are set to release their quarterly results. These earnings reports will give us a clearer picture of how well businesses are performing in the current economic climate. This renewed sense of optimism on Wall Street stems from the belief that the Fed will successfully manage inflation without sending the economy into a recession. This soft landing approach, which has rarely been achieved, is critical for keeping the bull market alive. Some analysts point out that 18 months ago, there was far more concern about a possible downturn, but today, that fear has largely dissipated. But here's the interesting part. While the big indexes like the S&P 500 and the NASDAQ are hitting record highs, it's not all smooth sailing across the board. Much of the rally has been driven by a handful of giant tech companies, especially those involved in artificial intelligence, AI. The broader market, including sectors like industrials and small-cap stocks, hasn't seen the same level of gains. The Russell 2000 index, which tracks smaller companies more tied to the U.S. economy, has struggled to keep pace. Despite this, there's optimism that as the economy remains resilient, interest rates may gradually decline, which could lift these underperforming areas of the market. This diversification could provide a new driving force for the stock market rally. The rise of AI has been a key theme in this rally, and companies that are heavily involved in AI development, such as Google and Microsoft, are expected to continue driving significant profits. Another element supporting the rally is the recovery in supply chains, particularly for the semiconductors that power AI applications. This recovery has helped tech companies remain at the forefront of the stock market's ascent. However, it's important to note that this is not just about tech. There's a growing sense that other sectors could catch up, which would broaden the rally and potentially reduce the market's dependency on just a few companies. Geopolitical concerns and market sentiment. Now, you might be wondering, what about geopolitical concerns? Historically, rising tensions in the Middle East or uncertainty around U.S. elections have caused market volatility. But according to recent trends, these issues are being downplayed by market participants who are more focused on economic fundamentals. Typically, such geopolitical shocks cause sharp but short-lived sell-offs, with the market quickly rebounding once the immediate concerns fade. In the same vein, the upcoming U.S. presidential election, which could bring about market volatility, is also expected to result in a short-term pullback, followed by a rally. As one analyst recently noted, the broader economic context almost always outweighs these political events in the long term. Longer-term interest rates, such as those on U.S. Treasury bonds, have been rising. This increase typically signals expectations of future economic growth, which bodes well for stocks. Even though short-term interest rates have been cut, the market is pricing in the potential for a robust economic expansion, further supporting the case for higher stock prices. Building a high-yield monthly dividend portfolio. Let's shift gears and discuss how to build a high-yield monthly dividend portfolio. This is a topic that resonates with income-focused investors who want consistent cash flow without the hassle of managing physical assets like rental properties. In today's financial landscape, there are several solid choices for achieving this, and I'll walk you through some of the top options. 1. DIA, SPDR Dow Jones Industrial Average ETF Trust. First on the list is DIA, an ETF that tracks the Dow Jones Industrial Average. While DIA may have a slightly lower yield compared to some of the other options I'll mention, it offers excellent capital appreciation potential over time. This fund has been around since 1998 and has a long track record of strong performance. Investors in DIA can expect their yield on cost to improve over time as the underlying holdings appreciate. This makes it an excellent option for those seeking both growth and income. DIA is unique in that it pays dividends monthly, unlike many other large-cap funds that only pay quarterly. With a portfolio that's well diversified across various sectors, not just tech, DIA offers stability and consistent returns. JEPI, JP Morgan Equity Premium Income ETF, and JEPQ, JP Morgan Nasdaq Equity Premium Income ETF. Next up are JEPI and JEPQ, two funds from JP Morgan that employ an option strategy to generate income. These ETFs are known for their ELN, Equity-Linked Note, covered call strategy, which involves writing options contracts to generate premium income. Essentially, this strategy allows the funds to produce higher yields by selling call options on the stocks they hold. While this approach might seem complex, it's highly effective for generating monthly income. JEPI, in particular, is more of a value-oriented fund, which I personally favor at this time, especially as we see a potential reversion to the mean for value stocks. Both JEPI and JEPQ have low expense ratios of just 0.35%, making them cost-efficient choices for investors. It's important to note that these funds distribute the premiums they earn from selling options as dividends, providing investors with consistent monthly income. This makes them an attractive choice for those looking to supplement their portfolio's income stream. 3. SPHY, SPDR Portfolio High Yield Bond ETF. Finally, we have SPHY, a high-yield bond ETF that focuses on providing monthly income through exposure to corporate debt. This fund is a great choice for those who want to add bonds to their portfolio without taking on too much risk. With nearly 2,000 holdings, SPHY offers broad diversification across various industries, and it currently yields at the top of its historical range, making this an opportune time to invest. What's particularly appealing about SPHY is its shorter average maturity, around 4.8 years, which reduces interest rate risk. Many private credit funds have floating rates, which means their yields can decline when interest rates fall. But with SPHY, you're locking in a solid fixed-rate return over the next few years. For those who are wary of the risks associated with high-yield bonds, it's worth noting that SPHY spreads its exposure across a wide range of companies, significantly reducing the risk associated with any single bond defaulting. The fund also has a very low expense ratio, making it a cost-effective way to gain exposure to high-yield corporate debt. Final thoughts on market outlook and portfolio strategy. So, where do we stand? The stock market continues to show strength, supported by favorable economic conditions, robust corporate earnings, and investor confidence that the Federal Reserve will successfully manage inflation. While tech companies, particularly those involved in AI, have led the charge, there's optimism that other sectors will follow suit, potentially broadening the market's gains. At the same time, building a high-yield monthly dividend portfolio can provide investors with a steady income stream. By incorporating funds like DIA, J, and SPHY, you can create a balanced portfolio that generates monthly income while still providing opportunities for growth. Remember, investing is about balancing risk and reward, and this type of strategy can be an excellent way to achieve both. So whether you're looking to replace income from rental properties or simply want to diversify your portfolio, this approach offers a solid foundation. Thanks for watching, and I hope you found this analysis insightful. Be sure to like, comment, and subscribe for more in-depth market updates and financial strategies. See you next time.